Well, let's start with the cause. First, inflation in Japan has proven more persistent than expected, and energy prices, elevated by the Middle East conflict, are adding to pressure. Second, the Bank of Japan is moving away from its ultra-loose policy settings. And thirdly, Japan's Prime Minister Sanae Takaichi, a long-time advocate of aggressive fiscal spending, has pushed through a major supplementary budget funded by fresh deficit bonds. More supply means lower prices for existing bonds and higher yields. And that's because bond investors are demanding higher returns to hold Japanese debt. All this puts the Bank of Japan in a rather uncomfortable position. Now, markets are currently pricing in a roughly 78% probability of a rate increase. A move would take the policy rate from 0.75% to 1%. Now, on paper, that still looks low compared to the US or Europe. But for Japan, it is a major shift. The BOJ spent years suppressing bond yields through massive bond purchases and yield curve control. Now it's trying to normalize policy without destabilizing the bond market. And that is a delicate balance. Now, if the central bank hikes too quickly, it risks adding pressure to the economy and financial markets. If it waits too long, well, inflation and bond market stress could become harder to control. And here's where Japan's domestic bond stress becomes a global story. The country has a huge stockpile of overseas assets. The government held more than 560 trillion yen, that's about $3.5 trillion in net external assets at the end of 2025. That makes it one of the world's largest creditor nations. So when Japanese yields rise, investors have a strong reason to keep money at home. Higher JGB yields can make domestic bonds more attractive and may reduce demand for foreign bonds. It can also trigger capital repatriation, where Japanese investors bring back money from overseas markets. Now, if that happens on a large scale, it could put upward pressure on global bond yields, including US Treasuries. Then there is also the yen carry trade. Now, for years, investors borrowed cheaply in yen and invested in higher yielding assets elsewhere. But if the BOJ hikes and the yen strengthens, that trade becomes riskier. Investors may unwind positions, buy back yen, and sell risk assets. And that can hit equities, credit, and emerging markets, especially in Asia Pacific. So the market impact is not just about Japan, it is about global funding conditions. The central bank's June meeting will therefore be watched not just for the rate decision itself, but for what it signals about the future of Japanese money. For CNA Explains, I'm Roland Lim.